Blockbuster new report making waves throughout the multifamily industry. A new report, it's a research brief from Gray Capital Research on rent growth and performance in 2023. Welcome to Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active, passive, you're in the right spot where we are breaking down all of the latest research and information related to the multifamily industry, real estate, and the economy, giving you those pieces of information to make some really well-informed decisions. Like I said, really interesting show today. We've got the new research brief from Gray Capital, as well as pieces from Globe Street, talking about WeWork headed towards disaster. Also from CRE, the mid-year global real estate outlook. A piece from RealPage, talking about how rent growth is slipping. How much further could rents cool? We're going to be looking at some long-term year-over-year as well as some month-over-month data. Marcus Millichap, CRE transaction activity trends. You can imagine they're way down. And also from Institutional Property Advisors, another mid-year multifamily outlook. And then looking at some office to residential conversions. Two articles out this week, one from The Real Deal, one from Globe Street, talking about a report from the federal government looking at the feasibility of converting office buildings to apartments. A little bit of a spoiler, but it's much more challenging than most would like it to be. And then more analysis from the Gray Capital team. We got Dr. Matt Bosnagle. Let's get into it. Welcome back to the Gray Report, joined by Dr. Matt Bosnagle.
Hello.
Director of Communications and Marketing here at Gray Capital. Matt, we're wearing the same thing today, looking good.
Yeah, that's right.
I like the shirt.
Bound to happen sometime.
It's bound to happen. Yeah, we guess we need to get some more gear.
Yeah.
Get some more gear. We need to get a shop so everyone can buy some Gray Capital swag.
Yeah.
We digress, though. Matt, we've had some comments from some listeners renaming the show the founder and the doctor, which I thought was interesting.
Yeah, it is a funny name.
Yeah.
Only because the doctor is funny to me.
Yeah, well,
not the good kind. That's always have to.
Well, maybe not the bones and medical doctor. But
I went to grad school.
We went to.
I always tell
PhD.
I tell people it's like a puzzle you hang on the wall. It doesn't really help you get a job. It makes you look kind of nerdy. And yeah, just.
Have you thought about wearing glasses? Did it go full?
And maybe
all the way. Anyway, hey, that's okay. Well, Matt, how are things going for you this week? I mean, we just released the rent report yesterday. I know there's been a lot of effort. We'd mentioned it previously on the show, but now that is been released, and you can go find it over at graycapitalllc.com/rent-report. Just go to graycap.net. New way to get to us as well.
Yep.
But Matt, putting together this report, what do multifamily rents look like, and what's the outlook say?
So, we put together this report. Just to kind of summarize, it started about a year ago.
Yeah.
Where and it was an outgrowth of the stuff that we were doing at Gray Capital, which was keeping people informed, chasing after the latest rent reports that come along every month. And there are 8 of them that we've really identified as ones that continually give you monthly rent growth data. Problem number 1 is the ones that come out every month. Those are about a year ahead of the CPI. So we're all, and people are well familiar with that. Problem number 2 is there's 8 of them, and they're not the same.
Well, okay, so let's just back up a little bit and unpack it a little bit, because I think a lot of our viewers, listeners are familiar with the fact that CPI and month-over-month rent growth are different. What is the difference? So because CPI is coming out tomorrow, and a piece of this report basically states that CPI rent growth contradicts market reality. So what is the difference for those that don't understand or may not fully understand? When I'm seeing, when I see rent growth on the CPI report that comes out tomorrow, and that's different from what I'm seeing in one of these market-based reports, what is the difference?
In a nutshell, CPI measures all the rents, so it's either from renewals, whether you're currently what you're currently paying, as well as new rents, And then the stuff from the private rent growth trackers is mainly measuring new rents. So we're talking about the rents that you get if you're just starting out and versus the rents that you pay that everyone pays on average.
Yeah.
And when I say leading indicator, so the new rents lead the CPI by about a year.
By about 12 months.
Yeah. So it's not that CPI is bad data. They're just measuring an average of all the rents versus all the new rents.
Yeah. So like a rent that was signed 10 months ago, and let's say that it was well below where market rents are today, which that may not be the case anymore. But let's just say that it was.
Yeah.
That's going to show that a CPI may show that rents are lower than compared to new leases that are being signed today. So like what I see if I go to apartments.com or wherever, or if I'm signing a new lease, I'm a new tenant, new resident, I'm going to pay, whatever the list price is versus someone that's been living at an apartment community, they're renewing their lease. Maybe it's a big increase. Maybe it's not flat. Maybe it's somewhere in between versus, maybe you could be a long-standing resident of years and maybe your rent hasn't increased. So it's looking at just kind of what the effect of rent on the average American, so that's not a bad data point.
Yeah, exactly. It is the pressure of rents, what people are paying out of the pockets on average. It is and I think we've talked about this before, and like how, it's the impact of the pocket on their pocketbook.
Yeah.
It's just not a representation of the market.
Yeah, and so that's I think that's the distinction of when we're looking at when we're looking at this data, because we were looking at the CPI print. It's basically what the inflation number is. That's what the Federal Reserve is going to be looking at to be setting interest rates. But when we're looking at where is the rental market today? Like, where are we headed today on the market rents versus these are things that happened a year ago. Yeah.
And I would argue that the current rents are a valid indicator and could, those current rents may not be a representation of the pocketbook, but they are a representation of the push-pull and negotiations that create the price in a way that a lot of the other goods in the CPI market basket are.
Yeah.
Gas prices is a constant negotiation of, there's some external factors there, but there are a bunch of other good, like eggs. Those are bought and sold every day. And
it's what I'm paying that price every day. I'm not looking at my I didn't buy my eggs last year.
Yeah, exactly.
I didn't fix my price of my eggs last year.
Yeah.
But it does make sense. But it also explains why when we saw rents declining at the end of 2022 and beginning of 2023, but then the CPI report come out and it would show huge gains in rents. And we're looking at it on the market surveys, like rents just falling across the country, besides the Midwest, I guess. But the CPI would show a huge gain. So there was a big discrepancy there. And now what we're going to see, rents are, kind of they've been normalizing, but they've been growing.
Yeah.
But they're going to be growing as CPI starts to the rents and CPI are going to start to show a real slowdown and decline.
Yeah.
And so the narrative is going to be like, oh, rents are really declining. And it's like, yes, they did, but now they've recovered. So it's almost something that we're in a time.
It's really interesting too, because this time capsule's never been sharper because we're dealing with a multi-year.
Yeah.
We're a lagging year, but we're really dealing with about a 2-year price spike. From baseline up to the highest, back to the baseline. That could be, what is it? It's a dang near 2 years, and so you're going to get a lag.
Look at the graph that you included on the report. I mean, we saw the big increase and CPI. Is that what this is? This dark line. So I mean, it's much more smooth, and I mean, it does start increasing eventually. But you saw that it was still increasing while market rent growth had just completely, fallen off a cliff. And now, as market rents are picking back up, it's making its way down. So it's a really interesting phenomenon because typically there isn't this much movement in rents. It's usually a little bit up or flat, and then during a recession, rents can come down. But typically it's just like kind of slow and steady growth. So there aren't as big of discrepancies. It's not as big of a question. But housing makes up a third of overall CPI. And why this matters to anyone that's investing in anything, trying to figure out where inflation is going to go, is we know that we should see rents really start in CPI showed a really cool coming up, that what they did in July and in August, and then really by September they should even be have negative growth.
Yeah, I mean, we're talking about a good 3/4 point, knocking off 3/4 of a point of inflation, maybe it's core inflation.
Yeah.
Just because of how much we have to drop in specifically in rent of primary residence. I'm not even talking about housing prices, those are, but this drop in, because it's about 8% or so, maybe 8 to 10, depending on if you're doing core or, everything, it's going to have a really big effect on top line inflation.
Yeah. I think the big question, I think, we could confidently say that, okay, that we're going to see inflation come down, top line, headline inflation. The big question, is really the energy market and of where, energy prices, if they really surge.
That's what I've been thinking.
And there's not as much supply, and there's much more conversations around that. So I think that's the other kind of inflation driver to watch. So I don't think we can say, for sure. Yeah, certainly, but there's certainly a recipe for inflation to at least show that's going to continue to cool down. At the end of the year, in general, kind of a slowdown people are calling for, which makes sense. Yeah. Then also around the same time, if we do start seeing some distress in commercial real estate, it should be coming up.
And I'm probably gonna be repeating this.
It's okay.
throughout the report, but I was talking to you beforehand, and it is almost like we are facing, earlier in the year, I was like, well, what's happening? And we are facing two different scenarios that could play out. One is higher for longer. I'm talking about higher interest rates, maybe even a little bit higher inflation, where we enter a monetary tightening regime, or a whole regime, a whole long-term thing where interest rates are just higher, and we just have to live with it. That means no recession, because the other scenario is a recession triggers interest rates going lower.
Yeah, it's got to get flushed out, and the full correction take place.
History says number two.
It should.
Yeah,
it should. And I think we're, in commercial real estate in particular, we are, I would say, halfway through a correction.
Yeah.
Maybe 3/4. Nobody knows, but we're in the middle of a correction. Let's call it that. We're not seeing a crash. I think the fundamentals of multifamily don't really set us up for a crash, but I do think that we have to get through and flesh out the correction before the market can really kind of reset.
Yeah.
And just looking at, basic, returns, of multifamily, cap rates, and then relative to other investments, I see us getting closer. I'm seeing more deals coming out in the 6 to 7 cap range, which they really need to be to make sense of an investment relative to other.
But if there's a recession that comes on and lowers interest rates, that changes it.
That makes sense. All of a sudden, it doesn't have to go to 7 caps.
Yeah. And that, the fact that, people are calling for, and CBRE is one of them, are calling for a recession in Q4 to Q1 of 2024.
Yeah.
And it's like, in a certain way, it's almost like a rescue of the sellers that are waiting on cap rates to come back down, maybe the environment to be a little bit friendlier, and the math to work out.
It'll help the math, but the problem may be, it's going to be interesting. I mean, like, a recession doesn't typically make things easier to transact, and credit's not going to get, it's going to get tighter before it gets looser.
Yeah.
And, but who knows? I mean, it may, the panic of a recession, could, there be certain types of accommodation and bailouts. We already know the Federal Reserve has given out guidance to lenders and commercial real estate to make, accommodations for these workouts, for these loan modifications. I think it's so bad, is there some kind of, bailout that could, which is not what the market needs. I mean, we need to kind of flesh all this through, so we can kind of reset. Get moving again. But, fear typically drives people to make decisions that are beneficial in the short term, but can layer on issues for the long term. So, and we've had a lot of those that have been layering up. Matt, I just also want to just mention, as part of the report, and again, check out this report, graycapitalllc.com/rent-report, really featuring a handful of markets, looking at their rent growth. Now, this is year-over-year rent growth, Matt?
Yes.
Year-over-year rent growth. rent to income and new supply. So we're looking at kind of like what it has been doing in terms of demand in the form of rent growth. Looking at how affordable the market is currently, and then also looking at how much new supply is coming on into the market relative to existing supply. Matt, and some of these numbers, Matt, are lower. The new supply numbers are lower than on previous reports. And so I first wanted to ask you about that, because like I'd seen Salt Lake City like punching up against like 10% new supply relative to existing inventory. These just the freshest numbers.
I took the current supply as the denominator and the new supply the new deliveries in that 12-month period as the numerator, and that's what you got for most of them. Now, I would note that the rent to income is going to be skewed. The population is all households, so it includes homeowners as well as renters. But what is useful,
it's still really tracking.
Yeah, and what's useful is a way to compare. So maybe the absolute number may not be right, but I'm sure that the relative affordability of Miami versus Chicago or Minneapolis, like that's going to probably track. And I was actually a little bit. So there was some studies that I've seen where Miami, the rent to income was a lot lower than it is, but when I did the math there, it's high enough where it kind of just it does make sense that it's expensive to live in Miami, which has the second highest rent to income at 40.94. Number one is New York, obviously at 44.62. But these come closer to some of the estimates that I had, where people were saying, people are spending some. If you live some places, sometimes you're spending half your rent or half your income on rent. And so
it definitely does track with some of from the stories that you hear. And it looks like there's about basically 1 million multifamily units under construction. As of Q2 2023. So obviously those aren't just being all delivered in the same year, but that's still a lot of units under construction. But we need a lot of units throughout the country also.
Yeah, there was an article that I didn't make the video. It will make the newsletter. That construction times are still
a little delayed. Yeah. Awesome.
Oh yeah. One more thing I did want to know, and I'm glad you have this up here too, is the real driving reason behind me finding these or me tracking these is I wanted to figure out what the difference is in the variability between these 8 individual rent sources. And so here the most indicative chart that I have that shows how different these are is the month to month. You see Redfin, clearly the most volatile of all of these sources. They've actually they don't put their month-to-month rent growth on their rent reports anymore. What you have to do is do math. What? So the number's there, but they don't have it because they may know that their numbers are a little more jumpy than other numbers. Yeah. So Redfin hit almost 7% month-over-month rent growth in November 2021. Did it hit it? Did their numbers come? I'm not sure how that shakes out.
Crazy annualized figure.
Yeah, exactly. And I think that was numbers like those that maybe made them think, okay, we're just going to hide our month to month. But it shows that like you can't rely on one source. You got to measure them against each other, because if that was your picture of the market, then you're going to go insane.
And Redfin their rent reports get a lot of media attention too.
They do. Yeah, they're a very prominent source that perhaps a little more shaky, a little more volatile.
Now, I mean, is it higher frequency? I mean, is it getting us, better data? Is it just the data is more volatile than some of the other reports? Okay, or so what's your thoughts? Is it really good or
I don't think that a lot of these sources, and I looked at the methodology of all these sources. Redfin has a scant like 1 or 2 lines of their methodology. Yardi Matrix has a whole document that defines terms, and Apartment List does it equally really well, and just outlines the equations that they use, and the process are very upfront.
And is Redfin taking is it more skewed towards single family home data versus multifamily?
I wonder if they have a robust set of information on single family homes. Maybe the rental market, maybe their numbers are just lower. That would make sense. I could none of these sources actually reveal the number of their data set, and that I can kind of really understand.
Yeah, it's proprietary,
but
extent.
I would think that a lower sample size would be a lot more swingy up and down than if it's then it's a bunch of them.
It's true. And also, if they're using any sort of, modeling and trying to even it out, and maybe it doesn't even out, maybe it makes it more extreme. So just, more of an asterisk when you're looking at some of these reports to know to take some with a little bit more grain of salt than others. And so if you see a Redfin rent report that's really spiky and extreme, maybe like, well, okay, maybe I should read another one, or just pop on over to Great Capital, great, .net.
I want to find a little. We can have our little real clear average.
Yeah, exactly. All right, Matt, let's move on to this report. It just came across the wire. WeWork, famous co-working firm that has had much trouble in the past, is at risk for bankruptcy. Has co-working died? Matt, as you and I were talking about, this is I think, it sort of has to do with co-working, but probably more to do with WeWork.
Yeah.
But taking this so we can get through it, co-working, has that died? Or is people just working from home now? Like, instead of like this early on, and then I'm going to shut up. Before the pandemic, you were starting a business, have a little startup, you're starting something. Yeah. We need to get together in a spot. You rent a WeWork because it's way cheaper and more flexible than renting, space. You have to have, 5-10 year lease. But it wasn't cheap because, I looked into it at a point and it was not cheap. But now, like, if you're in a startup, like, why spend that money when everyone is so used to, and we all have the tools to work remotely, and we're all kind of have our home offices set up. So I give some credence to the fact that there's just not the demand for co-working space that there used to be, but I could be wrong too. I don't know.
I wonder if they set their rules up, they set up a little bit of a business plan, or at least they got kind of entrenched in kind of pre-pandemic paradigm of, you sign up your whole company to a WeWork. You get these startups, they sign up to a WeWork. They don't, and maybe they didn't jump on the transition from remote working, and so the movement away from the office could also mean that you rent WeWorks. That's
true.
You give up your lease. Instead of signing maybe a longer term lease with WeWork, they jump into maybe shorter term leases, or they help these companies that are downsizing their office space by saying, hey, we can rent you some flexible space, and you can see how this kind of works out.
I definitely think co-working has a place, and it's not going away.
Yeah.
But the model of basically arbitraging of what WeWork would do would like lease out a big space or like a whole building, and then from an owner, and then they would sublease that, and they break it down, fractionalize it, build out a cool space to work.
Yeah.
And in arbitrage, the difference between they're basically buying wholesale, selling retail. In terms of their leasing.
I can't imagine office demand is down, so that's got to hurt them.
Do you think that actually there could be a co-working resurgence because of maybe some of the desperate opportunities in the office sector of like, hey, we've got all this square footage.
I bet so.
Vacant. Let's just turn it into a co-working space.
Yeah, I bet so. There is as office reorients itself, I think that companies don't know yet how much people are going to come back to the office, and they're not going to want to sign up for maybe a 5-year lease if they don't know where things are going. And WeWork could kind of step in, or IWG, which is a rival of WeWork that is actually flourishing. Maybe that's kind of what they're doing. And one of their quotes, the quote from the CEO of IWG, which again is doing well and not unlike WeWork, their quote is, the narrative hasn't yet caught up with reality, and reality is large corporations globally are moving to a much more flexible approach to how they support their people. They're moving towards hybrid working, and it's universal and it's gathering pace. It may be just that they're set up to kind of jump on the decisions that businesses have to make, and they're giving them that flexibility.
Yeah. Well, see, I don't think the story's fully written for co-working, but it looks like at least WeWork specifically looks like they made some specific mistakes relative. WeWork made some mistakes.
Yeah, and who knows? They could, part of these bankruptcy discussions could be inherited problems from their earlier collapse, and nothing really to do with how they're doing now or the state of the market. It's just, it was a little bit of bloated of an organization, perhaps.
Yeah. Matt, staying on that kind of the office track, there was an article on The Real Deal. Office to resi conversions are financially feasible, but just barely, according to a report from the National Bureau of Economic Research.
Yeah, I thought this was really interesting, and it goes against what I've been saying. So maybe I'm wrong.
But does it? It's a big report. It's 46 pages. I don't know. We literally just came across the desk today, so I don't even know if we had time to completely review it. But what you have read, Matt, what are the conclusions?
So under these conditions, now the title is what is it? From brown offices to green apartments. The brown offices are the kind of B and C class offices, and they're talking about converting those into green, energy efficient apartments. Now, the top line numbers, and I'm just going to put this out there. They said that developers under ideal, if it's just market rate, 16.8% IRR for the developer. Now,
it's pretty good. I mean, for a develop, here's the thing. Mm-hmm. So 16 some IRR, that sounds pretty sort of attractive. Mm-hmm. For you're more of a vanilla commercial real estate deal. I'd be like, okay, it's 16, nice.
Yeah.
But for I would call opportunistic development, redevelopment, where you're doing a full conversion, a redevelopment, a full lease up, a rebrand, a remarket, I'd like to see it punching over 20% IRR.
Okay.
Now, maybe that's hard to do now in this market with anything's hard to pencil like that in this market with interest rates, with leverage, with this type of project being new. So the amount of lenders that are going to be comfortable with it are going to be few and far between. So I might be excited, but 16% wouldn't get me like jumping up and down relative to the risk and return. But it's feasible.
Yeah, feasible.
Okay. Feasible.
So and I was also wondering that too. So
also academics putting together.
Well, yeah, there and I haven't completely processed a lot of their stuff. It's pretty in depth in here, and I would recommend really reading the Real Deal's summary. However, I was really curious about some of their figures here. Ultimately, their starting assumptions kind of is that this brown office building has to be at 40% of the value that it had pre-pandemic.
Yeah. Okay.
So the value
that sounds bad. That's actually maybe a little better than I thought, higher than I thought.
So you've got to start with a cheaper building, and you have to do it in the right place with the right regulations. But all of that considered, they say that 15% of office space is actually physically suitable for conversion.
So only 15% of all existing office space is even.
Yeah, it's physically suited now. And I need to dig in specifically. That 15% number could be brown office buildings specifically, these B and C class. And I would think that that's right, because I'm guessing that those brown buildings are kind of smaller. They're not like the high rise. Maybe have a smaller footprint, but yeah, I'll have to check that. Either way, if you take the remove the buildings that have long-term tenants in place, that 15% number only goes down to 13%. So still, there are 13% of these kind of empty-ish brown office buildings that feasibly.
That's a chunk. That's a
lot more than I thought.
Yeah, that is more. It's way better than 8% or 5%.
Yeah. Still, a really interesting. What they say about the IRR. Now, I think that the risk is got to be is a big part of it, and they do.
Now, are these also, so when they say, and sorry to interrupt, Matt, but the green market rate apartments, are they doing more work to make them environmentally friendly? You wouldn't have to do.
I didn't dive into that because, and I wonder, is that what you have to do to get a government paper written. Put a green A in there.
Yes.
But like I will be completely honest, I have nothing against green energy.
Yeah, no,
or
why
green
not?
buildings or whatever. I bet that making it green makes it a little more expensive.
Sometimes you can have it's sometimes there can be conflicting goals and incentives, and people trying to do like really good things can get caught up in trying to do too many good things all at the same time. When I was more in kind of the agriculture space, I remember going to a couple nonprofits, and this one nonprofit, they were employing current inmates of a women's prison to come on and work on the farm to get like experience and just job training, and they weren't like working on that hard. I mean, it was a very like crunchy organic farm environment in Oregon, but they were also growing food to like send back to the prison, and but then they were also all trying to do everything organically, which was like great. But then but they were, the people were learning about it, so like the results and the production wasn't that great. And I remember asking like, well, if that were just growing conventionally and non-organic, so you can grow more food, is the goal to give people like some job experience, help them to get off and provide some food? Or is it to lean into the organic movement? Yeah. Some of these things are conflicting.
Yeah. You get a lot more carrots.
Yeah. It's like, do you want to just grow more food?
Yeah.
And now they're in their mind, and I get it, it's like, if we're going to do it, we're only going to do it organically. Like that's in their mind. And I think it's the same mindset of, if we're going to do this, if we're going to build in new buildings, or if we're going to go through this effort to do it, let's build them for the future and make them as environmentally friendly and as efficient, sustainable as possible. But providing affordable housing and providing sustainable buildings are somewhat in conflict. Yeah, because the more expensive it is to implement some of these environmental policies and to convert the building that way, you're gonna have to charge more in rent. And again, you can say like, well, that just is what it is, and that's the only way we're going to do it. But then we have a housing crisis and affordability crisis still, and so what are we solving for? Yeah,
that's what I was interested. Is like, if you want to alleviate housing, maybe you don't need to make it completely green. However,
let's get rid of the red tape, and again, it's more barriers and regulations that are getting in the way of housing. It's like, it's not a bad idea, and there's ways to incentivize it, like through financing, giving slightly better terms, which is what they've done in the multifamily sector. And there's definitely ways to do it that don't like prevent, but I just wish that maybe the working paper wouldn't have like focus only on that.
Yeah, it throws another variable in there that's like, I just want to clean, like, all right, they make a really interesting point, man, that 15% number, or that IRR is like, wow, that's more than I've ever thought of.
That to me, that definitely is showing that it's closer. Again, I think some of this is in, it's like in New York City also, things can be a little bit different than other markets.
And they're talking about, tax considerations, and I think that a lot of the argument, some for like green investment or for things like this, I'm sure they're like, oh yeah, well, you'll pay less in energy bills or something, but I'm not sure.
Sure. And that's the thing. A lot of times it makes a lot of sense economically to make things more efficient. I mean, efficiency is good. Bills going down is very good. Safe environment is good also. I'll just see if we can be profitable and actually economically sustainable to continue to do that thing.
So as RealPage or as the Real Deal polls out, this plan is really only feasible in places like San Francisco and New York. I think they might have said Boston too. There are a select.
Yeah, there's a map I'll go back to. Indianapolis is not one of them. Yeah, that's okay. That's because real estate's a little more less volatile.
So you can So there's,
I mean, think about places with a lot of office buildings. They're probably now going for cheap. Places with high rents also, so you can get a big premium once you bring them to market rate. It's
big in the Northeast. You got some in the LA area, in the San Francisco area, Chicago. But really,
they actually list the amount of candidates in all these markets.
Oh, that's interesting.
Yeah.
Well, really promising for people that keep dreaming about office conversions. Now, I still think that despite the optimism of this report, it's still going to be a heavy lift.
Heavy lift. So it's gonna. I mean, people will do it.
Yeah,
it'll be done. But we will continue to see
Totally.
right updates.
Yeah.
Okay, Matt. Moving next to this CBRE economic outlook that we have, mid-year global real estate outlook.
Yes. First one.
Very, real estate is very local. So starting global, that's okay though, because we can start global and we can narrow our sights in a little bit. There's a video from Richard Barkham, the global chief economist at CBRE. What does Mr. Richards have to say?
This was a really interesting look, and he makes some comments about how the U.S. compares with other countries a little bit, and how and really a nice overview of the current U.S. situation and some of the factors that are pressing on these markets. Can't get into everything. This is a series of videos that I wish was a PDF, but that's fine. They're really good videos.
Matt,
and
don't you know no one reads anymore.
I know. They're not
watch video. That's why we have the Gray Report.
That's
why we're doing what we're doing.
Good point. All right, we're summarizing here. And right off the bat, they really hit us with kind of a no-nonsense take. The host, which is researcher Julie Whelan, asks global chief economist Richard Barkham, who I think you see here. She says, we expect a recession in 2023. She said, Richard, at the start of the year, your exact words for the U.S. economy were, we expect a recession in 2023, but we're not overly pessimistic. Do you agree with that statement? And what are your views globally? And then Barkham replies, he said, I would still agree with that statement, Julie. And I would say that the situation in the global economy has improved over the last 6 months, particularly in the U.S. and Asia. But I would also caution that we're still at peak interest rates and will be there for the next 6 months. So the downside or nasty downside, or the possibility of that, has not fully receded. I say it's okay to change your mind.
I think you have to be humble in this environment because it's okay. Because again, like no one knows.
Mm-hmm.
Like we know some things, but we don't know it all. We never will know it all.
Yeah.
And no one's lived through or studied a good analog to this environment, post pandemic. But I mean, even like going back to the Spanish flu, there was, a world war going on.
Yeah.
Obviously technology was in a different place. Money was a different place. Just the whole world, technology. So it's not the exact same. So how do we react?
Yeah. Yeah.
And then how do we react for a war in Ukraine? And AI and stuff like, LK-99, the superconducting.
And the aliens, they're coming.
And aliens. How do you factor that all in?
Yeah.
So be humble. If you didn't have the UAPs or the aliens in your model, it's all right.
Right.
Neither did we.
It's a black swan.
It's okay.
But so he does give some caveats and says really that the lane for the path to the soft landing in the United States is certainly wider than it was. But he does note that some of the European economies are struggling. Germany's not doing as great as it could. Obviously, there's a war still.
Yeah.
But
they also, they take 6 weeks off in the summer.
Yeah, that's right. Yeah, maybe. That's good.
I mean, which sounds odd, which sounds great. But I mean, they're like, why are we as productive? Well, why? I wonder. Why are we getting much stuff done?
But he does, there's places in Asia that are doing okay. I think he was pretty optimistic about Japan and how they're doing. So it's not a universal, like I thought that the picture of the economy was that the U.S. and this still is largely, I think, characterized as the U.S. is doing a little bit better than everyone else.
Yeah.
And we've bounced back in a way that Europe definitely hasn't. But it seems like Asia is not as scary of a place. Although, I still think that, China is this great big question.
I was just going to say China being, obviously the biggest player in Asia, and how they've seen a lot of, slow growth in their economy and maybe not as much stimulus as people were thinking that they were going to be pumping. There were some issues, I think, in their property sector that came up recently again. So that's a big question, and obviously a big engine for global growth.
Yeah. But ultimately, despite these caveats, his prediction, and this is the CRE's really prediction, that everything really flows from this. And I talked about these two scenarios, and they are on the side of a negative GDP in Q4 of this year and Q1 of 2024, and then capital markets expected to pick up in Q1 of 2024 as, I think, interest rates come down as a reaction to the recession.
Yeah.
He
Reasonable.
does he does include like a little bit of pricing adjustment that needs to take place.
The
And
other
I think
thing, I think that makes a lot of sense. Other than we just continue to be surprised by strong growth. I think we've
Yeah.
revised some GDP numbers from
Mhm.
this spring and summer, and they came back as stronger than originally recorded. So I think that narrative makes a ton of sense. Especially again talking about commercial real estate and some of the cliffs may go off at near the end of the year, and just other things that it wasn't just commercial real estate that kind of volumes peaked and then at 2021 and then it's 2 years later. And there's a lot of things that are going to be catching up to the U.S. and global economy.
Yeah.
So I think we will know a lot more in January.
Yeah. I do wonder how divergent these things are going to be, because he does say, if it does, the interest rates at the very least are going to stay high for 6 months.
Yeah.
According to their projections.
I again, unless there's like an absolute crash, I can't see them just falling precipitously.
Me neither. And again, this is the counterexample would be higher for longer. Headaches are still there. And people may characterize it.
But what
as
is long? But what is longer? For you're saying 6 months. Are we talking about years? Are we talking about five? The next decade.
I think maybe 5, maybe.
Yeah.
I don't. And this is I'm imagining a fanciful made up thing that hasn't happened in decades.
But do we think that inflation? So inflation last month was 3%. How high do rates need to be for how long? And what for the longest time we were the Federal Reserve was trying to create 3% inflation.
Yeah.
We needed a little bit of inflation. Now we've already had enough inflation for everybody. So, they're now 2%. 2% has always been the target.
Mm-hmm.
But in the lexicon of economists having conversations, a 2 to 3% range is not completely unhealthy.
Yeah.
With a little bit of growth. In fact, for borrowers, largest borrowers, especially governments, the U.S. government, we want a little bit of inflation. That's good to inflate the debt away.
Yeah.
But they also want rates to be somewhat moderate. And so can we? I guess where do things normalize? And that is that they're going to stay higher, as in higher than they are today, where they are today, or lower than they are today, but higher relative to the last decade. And
probably the last two.
Yeah, I think it's the latter. I think that I can see rates coming, and I've seen people say. I mean, I think Bill Ackman and some others are saying no, rates are going to continue. They're going to move up some more. Maybe we're going to be in this wage price spiral. Maybe if energy really spikes, we could really see some inflation. If we don't have this recession, we're just, as you said, Matt, we're just going to kind of keep growing, and it's not going to get flushed out. But I don't see the specific drivers. But again, I want to be humble. I don't know.
The only reason why I even am entertaining this fanciful idea of higher for longer is because it helps to explain what we've seen in the first half of 2023.
Yeah.
We had this in what if, the Fed toys with tweaking it down just a little bit, and then we see so much activity from all this pent up demand.
Yeah.
So who knows? But I think it would be a little more positive than a recession. But it would involve a lot of buyers and sellers in the multifamily market, in the CRE markets, to change a lot of their math, a lot of their assumptions in a way that they wouldn't if there was a recession, which is weird.
Yeah, very, very, very true. I think we shall see. And again, the other factor I keep thinking about, we're just talking about all, aliens and technology, but, more seriously, I think that the technology that is coming out with AI being, a big part of it, and other advances in, hard material science and all of the categories, surrounding it, these are all major deflationary advances.
Yeah.
Now, it takes time for all of that to actually be developed, industrialized, and seep into the economy.
Yeah.
I think AI is the one that can really be accelerated pretty quickly. That story's yet to be fully written, though, of what that looks like.
Yeah.
But we have to keep in mind, again, we don't know if it's 1, 3, 5, 7, 10 years, but that is going to have a downward pressure on inflation because we're talking about being much more productive. We're talking about cheaper costs of goods to produce everything, cheaper energy, faster everything potentially. Again, we don't know all the details, but if we took all that out in a normal kind of large business cycle, it would be appropriate for rates to stay longer for higher and to go back to that regime. But are we on a technology super cycle of just exorbitant amount of pressure that will keep inflation at bay? Because because who cares about oil spiking if we can, if we have, not unlimited sources of energy, but if we can make things so efficient,
really great
we
batteries.
can store energy. I mean, the batteries, it's going to be an exponential change potentially with this LK99, which is this material that is relatively, the ingredients are very, they're everywhere. It's, it's like, three ingredients. It's copper and a couple other things. Yeah. That's super conductive at room temperature. Which would completely, way we make computers, batteries.
Interesting. What
everything?
Copper and lead?
Yeah, it's copper, lead, and I think it's something else.
It doesn't need like cobalt or lithium.
No rare earth minerals, very widely available. And it just I guess the manufacturing process is it's relatively quick. It takes like 30 hours to you put it into an oven once you get the right combination of materials. But it can be challenging to, I guess, the kilning or the baking process. If you do it, you can mess it up, I guess. And so that process has to be refined because once this paper was released by this group of scientists in South Korea,
like a free version or something.
They kind of put it out there. I guess that there was a big rush. I guess they'd been working on it. They first discovered this apparently in 1999, but then they couldn't reproduce it, and they kind of was like a side project. And but then they started back working on it in the last couple of years. And apparently there was a disagreement between some of the scientists that left, and then there was a rush to put the paper out. Yeah, because they wanted to get credit for it for the Nobel Prize.
Yeah, that's what I thought. Yeah, he was worried that they would beat him to the punch, and so he released this open source. Yeah.
But then the experiment has been replicated in other labs with some having success, some not. But there's enough independent labs that have had success that okay, there's probably something there. But
people are talking about it a whole lot more than some of these rando announcements that you get from a small lab that says we got it. Well, we can't show you it,
but I mean, the way that it's described is that it's hard to imagine the advances that could come out of it if it is real. Yeah. But it would be, the way it's been explained to me is literally could be moving technology ahead 100 years.
Wow.
And moving towards as I've heard others describe, Star Trek economy. Yeah. Major reduction in scarcity.
That's
just
great.
Very cheap energy. Everything's gonna be faster. Flying cars. Maglev. All of that.
Well, all these dream stuff, but then I think you led with the right one, which is AI, which is a very real thing that it's not even a year old in terms of the popular.
There's no heart in it, and I know we're going back and forth. But yeah, so it's that's all at least years, if not a decade plus, to change how the world, the material changes in production. But on the AI, it's just all software, and it seemingly can be integrated. Now, we don't know what to use it for and how to integrate it, but the rate of adoption is incredible. Yeah, and I think we're having the right conversations about how to use it and what it does and what it could be.
I said it's not a year old, and that's not true, but it's, the big public release of it was, in the December or November of last year. What I'm thinking of is we haven't even scratched the surface of the best ways to use it. I think people are still using it to write an email or summarize something. We're going to get to a point where where every company has a little AI buddy that can comb through and do whatever and do little dumb grunt work sift through all the data and make decisions that you approve of or whatever. Get a little co-pilot that's a lot more robust and a lot more useful than what we have.
No,
right now.
everyone is going to have an AI assistant that will actually be useful. And think about like you, and I'm thinking about from like a, running a business perspective. You have a new hire, they come in, and it's hard to help somebody that you're training. It takes a lot of time and effort. Which is good. You need to have the person. I'm not saying you replace that, but if like you came in on a new job, or you've been there for a while, it doesn't matter. But if you're in a new job and you have a little assistant, like a built-in mentor guide, knows everything about the company, including the little nuances. So you could ask it, tell me about taking PTO or my benefits. HR questions.
Where's this shared folder?
Where is the shared folder? How do we write our emails? What type of lunch places does the team like to go out to? It's like, well, looking at everyone's calendar for the last 2 years, and these are some popular spots. Stuff like, if it could go into that amount of detail, what are our policies on this? Hey, I'm doing this task for the first time. What do I need to know? What are my first couple steps? And so instead of having to go to your boss and ask him something that like maybe you think that you should know, you can just go to your assistant. Now, a caveat is you still need to interact with humans, because there are always going to be nuances that you'll miss, and like there's always going to be a balance.
Well, that's what I was thinking is, there's going to be such or at least for me, is like I think a lot about accountability and attribution when you're dealing with AI. You can't just say, oh, it stole the copyright. I'm blaming it on AI. Well, now it's your responsibility. If you use that AI, you put your name on it, and it's a co-pilot. You should have it. You
don't turn the keys over to. Exactly. No, I agree. Well, it would be like do a report, and I went to Wikipedia and I just copied and pasted just the Wikipedia article. It's like, okay, no, that's
check it over.
Like,
but
you'd at least rewrite it, reformat it, and go to the sources that it cites and look at those. Do some work. It still requires work, but man, it can give you a big. It really help you get. I found it to be the most useful in helping start tasks. Like I'm at the beginning of something. It's a little bit new. Give me the outline. And
gives you a foothold.
It gives you a great foothold, and rarely, if ever, has it been like, this is it, I'm done. But it's like, well, this is a really great jumping off point. And now I'm going to tweak it a little bit, and I'm going to take this one, and I'm going to extrapolate on it, and then I'm going to take it out on my own and just redo it. And then I might dump it back in at the end and be like, fix my grammar, or am I missing anything?
And I wouldn't shortchange your own role. I think that people are saying, I asked it. You did it. Just take credit for it.
Exactly. No, I think, the art of the prompt, if you think about it, is it any different from, again, they're large language models, what we're talking about. Is it any different from having a conversation with a person? And the subtle differences that spoken and unspoken language can make and infer and can invoke different responses. Like someone's being interviewed. There's a difference between really good interviewers and just average interviewers. You can ask the same series of questions, but it's the specific way that you ask it, the order of the words.
Well, and I always thought this too, when we were starting, is like also learning to stop when something's good enough, or learning oh no, this needs a little bit more of this or that. You got to be a good reader and a good writer.
And give good feedback.
And give
like, okay, this is good, but change this about it. And know what the things that you can't even change. What those variables are, whether it's tone, style.
Words. I still don't. There's to make the AI pictures you have. There are so many. It's like computer code, and so I don't.
It is good. Okay, Matt. RealPage, as annual rent growth slips below 1%, how much further could rents cool?
So I thought that this was a really
classic stock image.
The invisible touch
real estate.
That is actually like a big brand of stock
one
image.
Day. Anyway, Jay Parsons, very popular guy in the multifamily industry from his great analysis that he just keeps pumping out on LinkedIn, but obviously he is with RealPage and does some good research himself.
We probably last week we commented on a LinkedIn post from Jay Parsons that was probably a draft of this. We covered a lot.
I've noticed it does that sometimes, which is great. It helps flesh out the ideas, gets the conversation going.
Yeah. So
and he is great interacting on LinkedIn. It's a great example of somebody that really knows how to work LinkedIn. I mean, you make a comment like on his post, he is going to respond to it at some point, especially if it's thoughtful.
Yeah, he's got a big following too. I wonder if that's part of his job, right? Hopefully he gets paid. He does it for fun.
No, I mean, yeah. Yeah, I mean, yes. I think that he has fun. I think he enjoys it, but it is also his job.
Yeah.
Just like this.
Yeah, for sure. Yeah.
We're having fun. Yeah, we're having fun.
Yeah.
But it is also a job. It is what we do.
I just
well, that's at least my daughter thinks thinks that YouTube is like the job. I'm like, it is like something that Matt and I do once a week. Yes, it's one of many things that goes on. But
it's a sweet gig.
She thinks that I go on YouTube and I'm a head soccer coach.
Maybe in Germany.
I take my 6-week holiday. Yeah.
But back to the real page. They've got year-over-year rent growth at 0.78 for July. So positive, but barely positive. Really covers the same regional differences we've mentioned a bunch of times here. Midwest and Northeast doing better. Sunbelt cooling. West cooling a little bit more. What I think that was really notable, and you can see if you scroll down a little bit how much the rent growth is going down, and it's. And what I am wondering is,
but it's also this is all year over year, so we've got a base effect situation going on. Is that it's looking back a year to this crazy spikes?
Now, this is what I think is. I think it'll be well worth comparing the rent growth of later this year as seasonal effects start to cut down on rent growth period.
Right now, it's the last surge. Right, we're witnessing the last surge before things really cool off.
Yeah, so we might get to a point where there is negative monthly rent growth later this year. Probably will,
which will lead to a miss on a lot of the yearly rent growth projections that when we covered those, Matt, and I know you'll remember, January-ish. It was everyone was calling for 3%. Because they weren't really sure what was going to happen this year. So it was like 3% is the long-term average. Let's just pin it at that, and it looks like we're on track to miss that. I mean, we could get a little bit more, but so
it's going to be a market by market thing, because I think that supply has been such a big factor for rent growth this year, unlike previous years where demand just powered through all new supply. But I'm going to be watching closely how if we do have negative, is it way more negative than it was in 2019 and 2018? So comparing this season's monthly rent growth to the pre-pandemic monthly rent growth of like the fall and winter, that's going to be really crucial to determining whether we are kind of correcting back from the cool down.
It is amazing, man. You've brought this up a handful of times of like, if this is the correction, it's kind of a weak correction, and it's like kind of a strong correction. Well, I've compared to the the massive surge, and again,
if you want to pull up the rent report, and you can see the curve on year over year rent growth. It usually the curve is the highest when you're dropping down. But our curve's kind of reversed. Like our cool off is gradual. The spike up was really dramatic. So
again, the question is, have we had the spike down, or does it? I mean, you would think that there's going to be a big spike down.
But
there's nothing in like the data other than just like a lot of averages and probabilities that it should do that.
Exactly. And
is what the data is showing.
Gradualness of it was probably helped by summer rent growth patterns, kind of bringing up rent growth period. It does seem very overdetermined that it's going to dip a little bit into the negative year over year. I would compare to pre-pandemic. That's the upshot.
So
really.
1.74 is our report. Year over year at RealPage is 0.78. So they've got a little bit less.
Well, this is a year ahead of the data from our report. But
got it.
And good news though, they kind of bury it a little with the headline as a little bit negative. How much worse can it get? But they're saying that the pace of the rent growth cooldown should level off, just like we kind of said that. And they also noted that occupancy is evening out in a way that compares much more favorably to the lengthy fall off in occupancy recorded throughout the year last year. So there was a big, there was a lot of occupancy that we missed, and that was a lot. Even as rent growth was still quite high, demand was falling off a lot. But we're getting better, and like I said before, I wonder how much this is going to be how much this leads rent growth.
Yeah.
And what we have for the future in kind of with that. And I think
think occupancies are looking much more normal like they were pre-pandemic. But we were so tight last couple of years, and so this again just is really kind of normalization. There's also a ton of supply coming online nationally, which is going to drive occupancies down. And again, but just relative to that supply pressure correcting off a major wave of rent increases, the performance is kind of tepid.
Mm-hmm.
Relative to what we could see, it's pretty strong as long as nothing else happens.
Yeah, I know. Yeah, exactly. We're hoping that the aliens, when they come, they've got good news, and they haven't heard us yet. So that's good.
No, they're watching the report, Matt.
That's good.
Leave a comment below. Yeah, exactly. All right, Matt. There's an IPA report, Institutional Property Advisors. Let's just do this one quickly. Home ownership barriers help higher end rentals navigate some supply side pressure. What's the skinny?
So this the subheading of this is really useful, and it does indicate how much. And CBRE said this too, how much the high mortgage rates have really helped luxury apartments, Class A apartments.
Yeah.
And I think that this is especially fortuitous because this is coming at a time in which a bunch of nice apartments have just been built, and a bunch more are on the way. I was just talking with my family about the new apartments coming in the suburb of Indianapolis, Carmel, and how some of these apartments are right near the highway, and I was like, who's going to want to live? I told my parents, those new apartments, they're going to be the nice ones. The new ones are always the nice ones. That may not shake out in the next 5 years or whatever, but when they build them, they're Class A.
Yeah, sure.
Like square footage may be different, I don't know, but they build them to be nice almost all the time, unless there's affordability.
Oh, no. When we build our apartments, Matt, they are not nice.
Yeah. Oh, this is good.
Yeah. But look at this graph. The luxury rentals offer cost-saving benefits, and we've looked at similar charts in the past, Matt. But look at that gap between a mortgage payment and your monthly rent payment. Again, people are like, "Man, rents are so high." It's like, yeah, but relative to buying, and it's like shelter is shelter, so they need to be relative. I think you could argue that the mortgage payment is really high, but people are still buying houses and paying it, and the rent is. Yeah, it's not low, it's high, but again, relative to a mortgage, it is not as high. We'll say low.
And that's a good unstated point that I haven't seen a lot of people talking about is, housing prices are still pretty high, and that's got to be a huge positive sign for the apartment market. Even as apartment rent's cooling, home prices are still high. Now that could be a supply issue, but they certainly haven't fallen. And, all things considered, what's changed is the interest rates have changed and gone up. The fact that they are still holding steady, maybe they've ticked down just a barely.
Just so there's no crash or hardly even a correction.
Yeah. And it almost makes me think that what this correction in rent growth is not due to declining housing demand as much as it is this kind of mathematical and supply driven correction of the crazy times that we had in the last year.
For all the cold water that's been thrown at the housing market, it's just steamed it off, burned it off. Just kept cooking.
Yeah. I think that they also have an interesting map that shows how demand has varied across the country. Apartment demand is not the same as rent growth, and maybe there's a little bit of leading indicators in some ways here. Now, a lot of these are, almost all of these are declining demand. It's just a question of how much has demand declined. Now, some of them, it's either, now some like San Francisco and Orange County, San Diego, and a collection of markets in the Northeast like Philadelphia, New York City, Baltimore, Virginia. Those are the ones that have declined vacancy or held flat. Most of this whole map is increasing vacancy, and it's clear places like Salt Lake City, vacancy is up more than 120 basis points. Phoenix, same case. Minneapolis, Charlotte, even Pittsburgh have had these jumps in vacancies.
Yeah.
But if we look back to the RealPage trend, where occupancy is starting to level off after some severe dips, when at the same time rent growth was growing, by leaps and bounds. So this may be a bit of a leading indicator. I think that if we track this over time, that we may, we're getting to a normal market. And I feel like that's interesting to say because the market's been not normal enough. But I also feel pretty confident that we are, because all of these charts, seems like things are really leveling out in a way, and the fundamentals make sense. There's a lot of the greater economic environment makes sense. All of these things. If we're talking about rent growth, like things seem like they're coming back to normal. It's got to have some weird thing that happens that throws it off, even with supply coming, at an incredible rate.
So 3% rent growth?
No, 3%. Yeah. I do think, and this is the realist in me, is rent growth nationally will be lower than pre-pandemic averages because of the huge supply. But, there's it's due to the massive amount of supply in certain select markets.
True. Very true. Then when you're looking at national averages, it evens up a little bit. But yeah, those certain markets that are seeing a deluge of supply, they're just going to obviously perform a little bit differently. And again, it comes back to a question, with all things being relative and correlated, if we are seeing inflation be sticky at, if in a 2% inflation world, we saw rent growth at 3%. Those are the standard assumptions. Then in a 3% inflationary environment, is normal rent growth still 3?
That's a really good
4?
point.
I mean, it's some simple algebra, right?
Yeah. Ooh, that's a hot take. That's a take of the day. As we, in a higher, if it's higher for longer, one of those higher things is going to be rent growth.
Yeah. I mean, if we're saying that inflation is going to be sticky and it's going to be around for a while, which will be pushing on wages.
One of the things I was thinking of throughout my notes too, and this is more as it relates to cap rates, is like, if these interest rates stay higher, it's just go to the risk-free rate. I don't have to work at all. And you're telling me I have to do work for these returns and I don't have to do any work for this return.
Yeah, I see multifamily deals being shopped out there for 2-3% cash on cash return, and I get almost 6% in a 5.5 in a 1 month T-bill.
Yeah. So it's
not that it's not total. I mean, we're comparing yield and total return, which aren't good metrics. Well, we're comparing yield and yield, but just I could go out on the maturity curve on a bond. And if rates come in, I could sell it for a pretty nice total return. Also, it's just so again, there's just relative to other opportunities out there. The current environment. You should be doing deals that have really strong cash flow. Yeah.
And
look for cash flow.
And even in a case 6 months out, these sellers are going to be facing this high interest rates. It's not going to improve in 2023. And I have a feeling, it will well into 2024. We'll see higher interest rates unless there's some major crisis. I do think about what is the booklet that we. When a property goes to market and a broker is giving you a little booklet that has pictures and has offering memorandum. I was looking for that word choice, and I keep saying that the last page of some of these
Matt has been in the industry for a while, folks. Don't worry.
The OM. I was like the offering memorandum, and so I always think of the last page of it as like, well, they have like potential strategies for this property, and if their cap rates are that low. Sometimes I think like, well, a potential strategy is you could find a rich vein of platinum in the property, and that would significantly up your NOI.
There might be oil under the, I don't know.
Yeah. You could strike oil.
You could put solar panels here.
That's the other thing. You could have you could use like carpet scraps for a really cost-effective renovation. But there's it's hard to get those NOIs up to justify the cap rates.
Nothing would surprise me that brokers can be creative.
Yeah.
that's okay.
I'll have to
It's their
talk to
job.
some of our
It's their
broker friends
job.
about finding oil. Have you ever thought that's a good scenario?
I mean, just you have to. We recommend having a
Yeah,
verifying yourself, but
Scenarios,
we don't know that there's not oil.
yeah, that's right.
Hard to prove a negative.
Yeah.
Well, I guess you can dig it up.
Mineral rights.
You have to do your environmental survey anyway.
Yeah, that's a good point.
Everyone, make sure you hop on over to graycapitalllc.com/rent-report to download the latest report and research brief from Gray Capital. It's really well done. You're gonna love it. Let us know what you think. Make sure you sign up for the newsletter, graycapitalllc.com, or quicker, just graycap.net. Super quick and short. But you're already here. Subscribe to YouTube. Leave us a comment. Man, we've been derelict in getting back. We respond on YouTube, but we need to bring all the comments, do a little segment.
We could have maybe an extra video we do later this week.
That's a good idea.
Yeah,
that's a good idea. Leave a comment. Let us know. And then next week, Thursday, August 17th at 2 p.m. Eastern, we'll be going live on YouTube, Matt, to do a whole little webinar thing on the rent report.
You gonna let me in?
Yeah, you're in. You're in. I gotta bring you in here.
Live. I'm gonna be live. That's great.
It's gonna be live.
Anything could happen.
We did it live before. It was fun. It was different. Well,
great.
It's gonna work out.
Yeah, we've done we did a live one here. Yeah. A live version of the Gray Report.
Mm-hmm.
Okay. Yeah.
Yeah, for the FOMC meeting, I think.
Yeah. Okay, it'll be fun.
Yeah. Appreciate your viewership. We'll see you next time on the Gray Report.